Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Andrew Pratt. Hey, Andrew.
Hey, Casey.
How long have you been at Wiser now?
It's been a little bit over 4 weeks now.
All right, 4 weeks in, and we're throwing them into a podcast to talk about the markets. So, kudos to you for just jumping right in. You've got 10 years of experience behind you. So this is not day one in financial services.
Right. Have a little bit of experience there.
So Andrew joined us about 4 weeks ago. He's our investment manager, Georgia Tech undergrad, master's at Georgia State, and he's also a CFA, Chartered Financial Analyst, which is, I think, the highest regarded designation in our field, which congratulations on getting through that.
Thank you. It wasn't easy having a couple little ones running around the house, but we found time and got through it.
I mean, that's a crazy test. You take the CFA, theoretically, doesn't work. I mean, it's how it's graded. You could score a 90, but if the rest of the country at the same time scored 92 or greater, you would fail.
I think I've heard different ways of how you can pass the exam. I think there is a benchmark that you have to get across all subjects. So if you do get a 70, which I know sounds not very high, but a 70 across all subject matters, you can pass.
Okay.
But there is some sort of curve to it.
Yeah. That's crazy. And it's a test. You take about one test a year. So it's just not when you just go in and test and you're done. Like the CFP. CFA is a little more lengthy. So congratulations on your hard work and welcome to Wiser.
Thank you.
So today, we want to get refocused on markets. This kind of been missing from our podcast topics here recently, and I want to make sure we bring this back into the loop every so often because we are financial planners. We are focused on the long term, but sometimes we do have to talk about short-term stuff like short-term market performance. And, 2023, it was supposed to be the year of doom and destruction. 2022 was a down year, obviously, and all the predictions for 2023 were horrible by everybody.
Just say AI.
Right, yeah, exactly. And of course, also in 2019 or in 2021, all the predictions for 2022 are very rosy. And so in 23 years of me being in this business, I've learned one thing is if they air quotes here, if they all agree, it never happens that way.
Right. Yeah, it's been an interesting year. Probably have heard that several times across different business cycles. But everything was pointing, we have these traditional indicators that were flashing recession going into 2023 and, some that have never, have 100% predicted recessions. But we had this artificial intelligence AI hype that really caused market expectations to drive up earnings growth expectations. So I think that's been one of the catalysts. There's been also stronger GDP growth and a strong labor market as well, and that's sort of caused the market to really perform well this year. There are a lot of risks out there. But, I think right now the main thing to be aware of is just to, maintain your current risk exposure, maintain your equity exposure, and just be cognizant of these risks that are out there.
So year to date, the S&P 500 it's
up over a little bit, over 17%.
Over 17%. Now we were down 18% last year. Now, unfortunately, right. If you're down 18, you gain 18 back, you're not back to break even. But
right.
But we're making headway. We see that in our client review meetings. So when you look inside, and this is a little off script, but when you look inside the top companies and their performance, it's really like what, 4 to 6 companies that are driving all this in the S&P. The rest, a lot of companies are actually down year to date.
Yes, that's correct. There's you may have seen the coin term the AI 7, and that includes companies like Tesla, Apple, Microsoft. Some of the old FANG names. Google. And these are the companies that have the strongest hype and momentum around this artificial intelligence theme. But you're right. If you look at the breadth, the broader index, just the performance among the other companies within that, they really haven't performed that well this year. And, they perform, when I say that well, they may be positive, but not up like 30+% like these other names are.
Yeah. Yeah. It always takes me back to the S&P 500. So there's many years ago, well, it started many years ago, people say equal weight all the sectors of the S&P 500, and years like this would not be an advantage to equal weighting.
Right.
You wanted that market cap weighting to benefit, which is why I've never used equal weight. And then it seems like the equal weight will outperform in little small segments, but not as much as the overall cap weighted S&P 500.
And I think one other thing that's important to point out there too is not just their performance, but also if you look at their valuations. I think the expectation is that these companies like NVIDIA are going to grow their earnings and grow into these valuations. But if you look at, like you said, the S&P 500 versus the equal weight index, the valuation just really goes, it's increased substantially, versus the equal weight. And that's also something to be mindful too, is, not all these companies are growing into their earnings expectations.
So another thing is we look at is growth versus value. So in 2022, value stocks, which tend to pay higher dividends, typically they can't really grow their market share, but they can be managed better. That constitutes a value stock. Versus growth would still be, Apple and I guess maybe Microsoft,
right?
Pepsi, that's a growth company. Coke is a value company. So we thought value is going to make its big comeback in through 2022 into 2023. That hasn't happened at all because no value company is probably doing anything with AI, if I had to guess.
Right. Or they're at least not reporting it on their conference calls as much as the other companies.
Right. Maybe they should work it in somehow.
Right.
But yeah, growth, you have a note here, growth says significantly outperform value. So it's beaten it by 24%. Is that for the quarter or is that year to date?
That's year to date.
So growth stocks up over 24% over value stocks. That's crazy. That means your grandparents' dividend funds are just sucking wind at this point.
Yeah. And again, they're probably up single digits, some better than others, but they're still lagging these top performers year to date.
So when we break down U.S. equities from value to growth, we also can go in by style or sectors, right?
Right.
So talk about some of the outperformers there.
Yeah, sure. As Casey mentioned, just looking at style, growth has outperformed value, and this has been a consistent theme all year. And the performance trends in the third quarter have really echoed what's going on in 2023. But also looking at market capitalization, large caps have also outperformed small caps. So that's been another theme this year. And then, going into sector performance, that is also mirroring the style performance with growthier sectors like technology, communications. So, these are the leading performers this year. And then you have the lagging sectors, which is also the more value-oriented, like defensive sectors, like utilities and consumer staples. They have really underperformed, this year.
And then international still is underperforming compared to U.S.
That's correct. And when we say underperforming here, international is up, over 11%. But compared to the S&P 500, which is up 17%, it is underperforming to some degree.
As asset managers, we always struggle with how much to allocate to foreign investments because relative to U.S. investments, foreign investments are a lot cheaper. They have better valuations.
Right.
And so over time, they should have a higher rate of return, but it's just not happening.
Right. Yeah, if you look over the long term, international equities have actually performed similar to U.S. equities, but have actually had higher risk. So that's not really a good combination with higher risk but similar return. But international equities are an important part of the portfolio because they do offer, they're still uncorrelated with U.S. equities, and they do offer those diversification benefits.
So in the chance that they do outperform,
right,
you want to have some in the portfolio, but if you look at like traditional Vanguard weightings, they're so heavy international. Even some of the BlackRock ratings models are way heavy international, and we continue to underweight in that category, partially because even when they outperform, it's just for very short segments.
Right. Yeah, they. Casey's exactly right. I think it's important to have a lower, equity split, lower weighting to international equities versus U.S. equities. But again, it is so important to have an allocation there, but they just have underperformed, and maybe they will perform going forward in a higher interest rate environment, but we just haven't seen that yet.
And another one is emerging markets. So that's Brazil, Russia, China, and India. And really, Russia's just been eliminated from investing at this point. I mean, when the war started with Ukraine, we quickly went and analyzed how much was in Russia, and it was under 0.1%. I mean, it really didn't matter to our clients' portfolios, or I would say most U.S. investors. It probably didn't really matter unless they're in a Russia-specific fund. But that landscape's changing. There's other countries being added to, I guess, S now. BRICS, BRICS.
Right.
Right. So that's what South Africa, I guess, is getting added now to some of the emerging market portfolios. But yet emerging markets just hasn't given us the rate of returns there that we've seen, especially like in the 90s. I remember when they had 60, 70% rate of returns in any given year.
Right. Emerging markets are, difficult to, pinpoint. It's really challenging, especially in a ETF format, because the ETF is capturing all these risks, where whether it's regulation, government intervention, you name it, it's really hard to sort of navigate those risks in a ETF format. But again, there's also currency risk you have to be aware of. So it is difficult to have an allocation to emerging markets.
One thing that for conservative investors in 2022 that was just so hard to watch was the bond market and what was happening with rapidly rising interest rates. We had interest rates rising faster than ever in history. And even our portfolios, which we saw that coming, but even in our portfolios where we had maturity dates of less than 4 years, we still hit pretty hard on the fixed income side. And unfortunately, that probably doesn't really fix itself unless the stocks the stocks really fall apart during a potential recession, right? But how have bonds performed year to date versus the slaughter they took in 2022?
Bonds actually, and we benchmark ourselves against the total market, the Barclays Ag, and they've been slightly positive year to date, which I guess all things considered, given the Fed interest rate hikes have been, it's not stellar, but we'll take that versus being down. But again, I think the main thing to remember is bonds are really more for diversification and protection of the portfolio. And, if there is a risk off environment and we do have a big drawdown in the equity markets, the fixed income portfolio will help, due to diversification benefits, will help prop those portfolios up and provide liquidity.
And one of the things that we did was, last year, we started reinvesting the income directly back into the bond ETF. And by doing that, you're capturing higher yields.
Right.
So over time, it'll heal itself.
Right.
But we just don't know how long that's going to be until it is.
Right.
Obviously, if interest rates stop rising and you think rates could be lower, then you want to take out your maturity further, right? So that you can benefit. There's some upside to the bonds. But you just kind of have to play your cards right and when to take that action.
Yeah, and we looked at our most recent investment committee meeting, we looked at where our benchmark portfolio is positioned, and we are currently in line with the total market's duration, which is about 6 years. A lot of asset managers earlier in the year were more positioned on the fronter end of the curve, having a shorter duration, which was to benefit because the yield curve is inverted, and that means that there's higher yield with shorter duration. But due to the expectation that the Fed's most likely not going to raise a lot more, and there are these risks out there in the market, a lot of managers have been moving their bond portfolios to moving duration out a little bit further, and as Casey mentioned, that will safeguard in the event of a recession.
So transitioning to the rest of the year. So we've got 3 months left, 12 weeks. How do you think things are setting up? Because people were still claiming economic recession. Even, I try to focus on the non-political news. So pretty much any mainstream media you have to eliminate from economic talks because there's a bias there. I try to look directly at what Vanguard and BlackRock and State Street economists are saying, and they're showing up some red flags. Right. Can you kind of talk us through what you're seeing in markets and how things are setting up for the next quarter to a year?
Yeah, I mean, it's difficult. There's positives and risk out there. Again, going back to some of the key risks that I see is, we have this inverted yield curve, and
an inverted yield curve, just for our listeners, make sure everyone's following, is when the short-term yield is higher than the long-term yield.
Yes, that's correct.
Your short-term interest rate is supposed to be lower than your longer-term interest rate, but right now it's flipped.
Mm-hmm. Yeah, and traditionally that makes sense because you're taking on this duration premium by, if just say you invest in a 10-year treasury, you expect that yield to be greater than a 3-month treasury because you're paid to wait for 10 years. So that has flipped, and usually that flips in stressed market environments. So that is a concern. Just in general, it causes lots of problems in the capital markets to have an inverted yield curve, and it's almost been inverted for a year. This particular spread measure that we talked about, the 3-month versus the 10-year, has always 100% preceded a recession. Again, it's been about a year, so we'll see if that holds true. But that's one concern for me. Another concern is there's an index that looks at leading economic data, and that's the leading economic indicators that's put out by the Conference Board. And they look at 10 different leading variables, and that leading index has declined 16 months in a row. The next release date's this Thursday, so we'll see if that reverses course. But again, it's just based on a weighting of those indicators, that composite has declined. So that's just saying the leading data looking forward is not as positive as we would expect. And then I think the other main risk right now that I'm seeing is just the difference between forward expectations in equity expected returns and fixed income expected returns, or safer assets. Not trying to get too technical here, but if we look at a earnings yield for the equity market index, that's just taken 1 divided by the forward valuation ratio, that we can derive an earnings yield, which is basically our forward expected return for equities. That's actually lower than a forward expected return for a 6-month treasury. So based on that, that just really means that risk-free assets have no standard deviation, no volatility. Equities historically have had 15% plus volatility. So you're basically having a lower expected return to invest in equities versus risk-free assets at this point in time.
And so when you're any investor is determining whether they should be invested in the market or not, basically your risk-free rate is the 10-year treasury, which is yielding 4% now.
Yeah, about 4%. And I'm actually, for this scenario or this analysis, I'm using the 6-month treasury, but the treasury curve is what I'm calling a risk-free asset.
So 4% that means that the stock market probably be giving you at least 8 if you're going to take on that volatility, which means that private equity ought to be giving you, 15 to 20.
Right.
Venture capital ought to be giving you something even bigger than that. And so where interest rates sit reorganizes how you invest. I don't think most investors really understand that anytime you have a Fed raises interest rates, the stock market resets, the bond market resets, because in the end, some people will go, if it hits 5, I'll sell a lot of my stocks and I'll just be fine on 5% a year.
Right.
So that's something that you have to pay attention to as an investor. Now, basically all these things you're saying are pointing to a recession.
Don't want to make a bold call here. I just, I think it's not a recession, but a slower growth environment. And, up ahead, there could be catalysts that change that dynamic. I just think there's a lot of uncertainty out there. We've had a great run this year. Valuations are higher above their long-term averages. So I think it just, to be mindful of the risks that are out there and to, just remember the importance of asset allocation and diversification within the portfolio.
So that being said, what action do investors take based on these economic indicators pointing to slow growth or no growth or a last minute repeat of 2022, maybe in the 12th hour of 23? What actions are we supposed to be taking as investors?
So, I'll first off and say that, clients are, at Wiser are positioned for the long term, and that's 10, 20 years plus, depending on your plan, return objective. But, there are things you can do. Again, you can rebalance back, just say, you have a lot of equity exposure and your equity allocation has run up a lot. You can rebalance back to your model's target. That's one thing you can do. Another thing you can do, even though we don't recommend it, if you're very nervous about the market, you could dollar cost average in and just, different allocate
for new money,
invest in different stages. Again, there's research has shown that doesn't work, but again, if it makes you more comfortable, that's something you can also do.
Yeah. What you're referring to is there's a Vanguard report out that talks about, do you invest all your money at once or should you dollar cost average it in? And that's just for people who have lump sums of cash. You sold a business, you have an inheritance that was cash. Statistically, it's better just to invest it. Even if you invested it at that worst possible time, you're starting dividend yields and other income generating from the portfolio, so that in the end it works out better than dollar cost averaging, which doesn't make any sense to the brain. So sometimes new clients who with lots of cash will still dollar cost average, knowing that this makes me feel better and sleep at night, but it's not necessarily the best strategy.
Right.
People think they dollar cost average with their paychecks, but they don't. Right? Because you get your paycheck and you can just invest 100% of it into the 401k, right?
Right.
You're the 401k allocation, the 10% you set aside or 15 or 20 goes right in. So you're not dollar cost averaging. You invested as soon as you had the money. So a lot of people get that confused, but in the end, that is a way to maybe mentally, get away from that. I think I would add that these were short-term predictions, and some of the best times to invest in the market are just right after recessions or right after that slow growth period. And the problem is you don't know when that ends because the market's moving 6 months ahead of what the economic data is showing. Right. And it's just better to stay invested. We have so many podcasts that cover this topic, but it's just better to put your head down and just kind of punch through the volatility or the down years in the market. And our Wiser clients did that so well in 2022. I don't know that we had maybe one person out of 1,000 people that actually pulled the plug, said, I'm done. And there were many reasons behind that. It was a poor choice, but there are many reasons behind that family doing that.
And I will say too, it's, when you're trying to be too tactical, you have to make two calls. You have to be right on two calls, and that's to sell and to buy back in. And a lot of times it's harder to buy back in on the other side. And, I've seen just research where a lot of people miss out on the returns, coming out of recession just because they bought back in either too late or they just didn't buy back in at all.
Yeah. And two, it goes back to the planning aspect. So you're managing portfolios here. The planners are doing the plans, and on the planning front, when we look at the probabilities of success, every one of those probabilities includes repeating the great financial crisis. Right. And no one's predicting that.
No.
I didn't know that's even possible to happen. I think we've learned how to put stimulus in the economy so fast that situation wouldn't happen again, right? But it's definitely probably not going to be all roses going forward based on what we're seeing. But on the positive side, the job market, not as strong as it has been, but still historically very, very strong.
That's right. I mean, unemployment's still near record lows. We have a strong labor market. And again, that's leading to GDP growth to be greater than expectations. And that's why the market has done so well. And that's why there is optimism out there.
So in the end, when you say diversify, you're talking about, diversifying against different asset classes or just not being any one stock, or explain diversification in your mind.
Yeah, diversification, mostly I would say across asset classes. And these are, different, they have different, they're either correlated with each other or not. And these asset classes have less of a correlation with each other. For instance, when the markets do poorly, usually, equities go down and bonds do well. So that's just something to help kind of provide your portfolio with a better risk-adjusted return over the long term. But you can also be diversified, intra-asset class, like within equities. You can have, a fund that focuses on, momentum or these large cap growth names like we do have in our portfolio. So you are capturing some of those outperformance periods, but then also have a fund that's a little bit more defensive and have more value characteristics. So you can be diversified at the asset class level, but also intra-asset class as well.
And we do that here well at Wiser by default inside our portfolios. We don't always talk about that because I don't want people to focus on portfolios. In the end, long-term healthy asset classes is what we're invested in. And we do make some minor tweaks along the way here and there, but I just don't want people to be over focused on logging in every morning, looking at the balance of their portfolios, or taking political news and incorporating that into the value of their portfolios. I just want them to be focused on living their best life, because through the planning process, we've already determined that they're going to be successful.
Right.
And there's just no reason to bring that fear and layer that on top of things. Now, our job is to also stay at watch and make sure that we're doing the best that we know how with asset allocation, and that's what you're here for. Is why I'm on the phone all day, is to make sure that you've got our clients' backs on the proper allocation. So. Andrew, we're happy to have you here, and we look forward to seeing your fingerprints on Wiser models and how we can focus on our culture of continuous improvement.
Great. Yeah. Thanks, Casey.
All right. A couple other episodes you might be interested in. Episode 163, how to maximize your earnings and your cash reserves. That's a lot easier to do these days. Episode 165, 5 principles of successful investing. Also, we have a YouTube channel called A Wiser Retirement. How to be a long-term investor will be linked to our show notes. And should retirees get out of the stock market? That's a question that was asked on Google. Doesn't make any sense to me, but we answered it anyway. You need the stock market in retirement. That's when you don't want to get out of it. Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can link to us in the episode notes. See you next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley.